Well, on behalf of Matt and the whole Seaside team, my name is Brad Lineberger, and I would like to welcome you to the 2023 year in review. And this is a wonderful opportunity to really take a look back at all the things that transpired in 2022. And we're going to talk about a whole bunch of things today. And then we also want to turn the page and talk about 2023 and the things that may be affecting you now and the things that you should be thinking about and preparing for this year. And we've gotten great feedback on the virtual format. It seems that people enjoy watching this from their couch and the comfort of their home and pajamas and slippers. And I don't know, Matt, why are we so dressed up today if everyone's in their PJs and sweats?
Hey, you have to give us some credit. We dropped the ties, the baby steps.
That's true, baby steps. We got rid of the ties. That's right. Yeah, people said we were too stuffy. No, all kidding aside, I think it's really important to keep you informed about what's going on. There's a lot of noise out there. It's easy to get distracted. It's easy to get overwhelmed and caught up in the day-to-day. And we want to help you focus on what you need to know. Financial education and empowerment is something that we really value around here. And we feel like that's a big part of what makes us different here. And so we want to be able to provide that to you on a consistent basis. So we're going to just jump into the major themes of 2022. We're talking things like inflation, interest rates, the war in Ukraine, market volatility, the bear market, recession, thoughts on Bitcoin and digital currency. And then, of course, we're going to help you and we're going to wrap by looking ahead into 2023. So let's just jump in, Matt.
Sure. Well, so like you said, to start it off, inflation was a hot topic last year. We all felt it. Well, maybe we are still feeling it every time we go to the grocery store and we're filling up our gas tanks. And it's been rough, but let's take a deeper dive into it.
Yeah, you got it.
And so what's so interesting is that inflation has been relatively tame for decades. In fact, during the Great Recession of 2008, the biggest concern was actually deflation. Right. The Federal Reserve was doing anything it could to prop up the economy and make sure that we didn't sink into a depression like we did back in the day. Inflation stayed very low from 2008 through the end of 2020. And then if you look at this magazine cover here from 2019, it's a great reminder that everything does go in cycles, even inflation. We all now know that inflation is not dead, although we do call it the silent killer.
We do.
And so after nearly 40 years of low inflation, it spiked up to 8.26% in 2022. We hadn't seen inflation running this high since the 1970s and early 80s. And some of us might actually remember getting spoiled with lower inflation periods over the last 15 years. And so while higher inflation last year might have been frustrating, the truth is that we've been here before. If you look at this chart, in 1968 to 1982, annual inflation was actually 4% or higher in the 14 out of 15 years. And then it peaked in 1980 with nearly 14%. And many of you probably remember buying a home with a 16% interest rate. So right now it may seem high, but like we said, we've been here before.
Yeah. Still painful though.
Definitely. So how did they finally tame the inflationary beast back then? The Paul Volcker-led Federal Reserve put the economy into a recession, not once, but twice. Volcker took over as Fed chair in the summer of 1979 and immediately began raising short-term interest rates. There was actually a time that it was as high as 20% before he was done. There was a brief time to kick off 1980 that was followed or there was a recession that kicked off 1980, and it was followed by yet another recession starting in 1981, just 1 year after the first one ended. So from the start of 1980 through the end of 1982, the United States spent 22 out of 36 months in a recession, and the unemployment rate was nearly 11% at the worst point of the cycle. So like today, people really hated inflation back then, but they also didn't like the recession any better.
True.
And so currently the Federal Reserve is taking a page out of the old playbook and started to raise rates in early 2022. While raising interest rates helps to reduce inflation, it has an impact on the bond prices. There's actually a indirect correlation between interest rates and bond prices. And so what I mean by that is that when interest rates go up, bond prices actually go down. And so if we look here, the Federal Reserve aggressively increased interest rates last year at the fastest clip that we've seen since the 80s. They were routinely raising the rates by 75 basis points at a time. Mortgage rates over this time nearly doubled. We went from 3% to 7% in less than a year. I remember that 5% feeling pretty high at the time, but I'd never thought that we were going to see 7% so quickly. But now with the housing market, which has been overheated, has started to cool off dramatically.
So what effect did that have on the bond market? With the Federal Reserve committed to a very aggressive rate-raising policy, bond prices had nowhere to go but down. In fact, 2022 was the worst start to a year for the bond market in history. Ouch. Very painful. So then in March of 2022, that culminated a 2-year period that was the worst 2-year period for the bond market in history. So it's been a very rough couple of years for the bond market here. And then on February 24th, 2022, Russia invaded Ukraine in a major escalation of the Russo-Ukrainian War. That began actually in 2014, but last year with the invasion, it caused tens of thousands of deaths on both sides, and it's instigated Europe's largest refugee crisis since World War II. We spent the entirety of the 2010s underinvesting in our energy infrastructure, and then one of the most important energy sources in the world basically got cut off because of the war. Things felt bleak, considering inflation was already at the highest level in 4 decades, and this was just a terribly uncertain time. And if the market hates anything, it's uncertainty. And all that uncertainty took a big toll on the market last year. So take a look, volatility picked up. We had over 100 days with moves of 1% or more in the stock market. This was right on par with the COVID-induced 2020 bear market. And it's interesting because when you look at more normalized years, all these other years here, you could see that volatility is nowhere near 100 days of 1% moves in a year. So last year had a lot of ups and downs, more downs than ups for sure. But if you were starting to feel it last year, you weren't, that's with good reason. You weren't alone. So we already mentioned the rough start to the year for bonds in 2022. Last year was the 3rd worst start to a year for stocks in history. And then by the end of June of 2022, the market was experiencing its 14th bear market since World War II. Now, on average, bear markets go down about 30%. Takes about a year for this to happen, and it takes about 2 years for things to recover. And so right now, we're about a year into this thing. Things are actually starting to look a whole lot better, but we're on track with the other 13 bear markets that have preceded this one. So from there, it only got worse. And everything was down last year, from US large companies to global real estate to emerging markets to bonds, as we discussed. There was just a whole lot of red everywhere. So there was just truly nowhere to hide. So in the US stock market, you had large growth companies, which had been the darlings for years, down almost 30% last year. And the best performer last year was US large value companies, down 7.5%, certainly holding up better than anything else, but still there was pain. On the international side, it definitely fared a little bit better than the US, but again, everything was down. Growth, again, being down way more than value, value being down just a bit, but still, nonetheless, a lot of pain last year. So then that leads to the concept that everybody's talking about, high interest rates, stock and bond prices down. all the talk about, war and everything else, everybody's talking about inflation. So the question is, can things actually get worse from here? And so everyone and their brother has been predicting an economic slowdown for months. And I guess when the Federal Reserve tells you that they're willing to throw the economy into a recession, you ought to believe them. I mean, if they're willing to throw the economy into a recession to slow inflation, I believe that they do. But the weird thing is that it would be hard to say that we're in a recession right now. I could always be wrong, but does this really feel like a recession to you? People are still spending money left and right. And I'm not sure that 7% interest rates are going to slow them down anytime soon. And here's just a couple of examples that I picked. I went on a couple of work trips last year, and every airport was packed. It was hard to find a parking spot. You had tons of people traveling. And the question, why are so many people traveling? I guess when you put off travel for 18 to 24 months in the pandemic, I guess it shouldn't come as a surprise. I'm surprised at how long this travel boom has persisted. And then at a birthday party recently, some friends told us that they just got back from the parks in Disney out in Florida. And they said that the theme parks were at capacity every single day. And people are still spending money. What's interesting is that everybody is expecting a recession to come. Everybody's calling for it. They're predicting it. I think it comes as no surprise. You can't go anywhere without hearing the word recession. And consumer sentiment is very low. And considering that the consumer makes up 70% of the US economy, this feels like a pretty troubling development. We know the reasons here: highest inflation in 4 decades, rising interest rates, supply issues, high gas prices, expensive housing, war, and a whole host of other issues. And of course, the media loves to just pepper you with this stuff 24/7. But if consumer spending is the main driver of economic activity, then 70% of the economy is actually in better shape than you might think about. You could argue that the consumer has never been more prepared for a recession that may be around the corner. Let me show you what I mean. Here's a breakdown from the Wall Street Journal. Federal Reserve data shows that people have been doing a great job of putting cash away in the bank in their emergency funds. US households hold nearly $18 trillion of cash. Indeed, before the pandemic, US households never experienced anything like the increase in cash that they've experienced over the last 2 years. And this remains true even after adjusting for the run-up in inflation. Simply said, people have strong balance sheets and are well prepared to weather the storm that may be coming their way. And it's not just the wealthy who are prepared for a recession. Across every demographic, from the wealthy to the middle class, even to lower class socioeconomic people, have been putting money away in droves. Everybody knows that this recession's coming and people have been prepared for it. The other piece of interesting news is that mortgage debt in relation to people's income is very low, much, much lower than it was in 2008. In other words, in 2008, people were over leveraged. They were taking bad loans. They were really stretched. We're not seeing anything like that. People are making money and they can afford their mortgage payments. Same thing with overall household debt. It's very low relative to the disposable income that people have these days. In other words, people are making good money and their debt levels are manageable and their bank accounts are full. So the takeaway here is that while we may experience a recession in 2023, it's not going to be like the Great Recession of 2008. And we all remember how bad that was. But the good news is that the housing market is in much better shape, and so are people's balance sheets. And while a recession may be on the horizon, the data would indicate that we're in a much better place to weather the storm. So that's a piece of good news.
Well, Brad, you know that when we hear all the bad news out there and the market being in a bear market territory, the media loves to jump on this and tell you that diversification doesn't work anymore.
Oh, yeah.
So just as a reminder for everybody, diversification is the process of not putting all of your eggs in one basket so you can protect yourself from market downturns like we're currently experiencing.
Yeah.
And so it is extremely rare for stocks and bonds to be down in the same year, but that's exactly what we saw in 2022. This chart shows until May of 2022. So about halfway through, stocks were down 12.8%, and bonds, which are typically the cushion of your portfolio, down 8.9%.
Yeah.
And to get worse, last year was the third worst year for a 60-40 portfolio. And 60-40 portfolio, what I mean is that 60% stock and 40% bonds. And historically, this has been the classic asset allocation for retirees. And so this is why the media has been saying and making the claim that global diversification is broken. And so you might be asking yourself the question, and it is fair, is diversification broken, and is the 60-40 portfolio broken? Let's dive into that and unpack it together. And so back in 1979, Business Week actually published this headline, and it says, "The Death of Equities." Basically, they're proclaiming that the stock market was dead after years of flat performance and with inflation running super high. The irony here is that they got it dead wrong. And what I mean by that is that the media told us that the stock market was broken, and then right after that, it went into a two-decade-long bull market, which has been the longest of all time. And so today, like we talked about earlier, the media is jumping on the bandwagon that 60-40 portfolio is dead. This is another way of saying diversification is dead. So the 60-40 portfolio was lights out for more than a decade. Then 2022 happened, and it's been one of the worst years ever for a 60-40 portfolio. So does that mean that the media was right? Or do they just not understand that things are cyclical, and that's exactly how investing strategies work? So definitely trust us when we say that the 60-40 portfolio is not dead just because it had one bad year. That's just how this works. So on the same line of thinking that this applied to the 4% rule, and that's a distribution strategy about taking withdrawals out of your portfolio to not run out of money. The media was saying that this technique didn't work either, but now with bond yields, they're now somewhere between 4 and 6%. So the 4% rule is back and back from the dead. Or maybe they were never dead to begin with. Everything is just cyclical. So investors go back and forth between fear and greed, being patient, and they panic. But the point is, things go in and out of favor all the time. And we just want to be here to remind you that we can never forecast or time which one's going to be the next hot topic or things like that. So that's why you just need to own a little bit of everything in order to succeed over the long term.
Yeah.
And so I thought this chart was interesting. So the long-term average for the US stock market is 10% per year. But if you look at this, the market rarely returns 10% in any given year. You would have to go back to 1993 to find a 10% return. You either get really good returns and you're way up, or you get really bad returns and you're way down, and everything in between. Just keep in mind, we are stress testing your financial plans to make sure that either one of these events happens, that you're still okay and on track to meet your goals. And over the long term, if you're patient, you are rewarded very, very well over this time frame. And so what we're looking at here is the US stock market over a long period of time and getting 10% return and what it looks like. So you can see that it's a nice upward trending line, and over the long term, it's very predictable. But what I want to show you is if you look at everything in between, what happens, you'll notice that there's yellow lines on here. That's when the market was down 5% over this 1957 to about 2017. And then the orange line is when the market was down 10%. And then the blue line is when the market was down 20%. So you can really see that it's near impossible to time the market. But when you really see the ups and downs broken out, a couple of things are here. Like we just said, market timing is near impossible. But investing over the long term, getting that black line rate of return is very predictable. It just can be challenging at times because it can be very painful, and that emotional feeling that comes on when we're seeing the markets go down. But over the long term, we know you'll get those expected returns you're looking for.
So speaking of patience, we've been talking about something for several years now. growth companies have been running away with the show from 2017 to 2020. And it led many people to ask, hey, should we put all of our money in the big tech names? Remember the fan mags we talked about a couple of years ago? Facebook, Apple, Netflix, Microsoft, Amazon, Google, the big tech darlings. Growth companies were outperforming value companies by a handy margin at the very end of 2022. Well, the tide finally turned. And from the mid 2020s onward, value has rebounded and it's outperformed growth by 36% in a 2-year time period, which is just astronomical. In fact, Facebook lost 26% in one day, on February 3rd, 2022. Even Bitcoin was not immune to the drubbing. Bitcoin got shellacked in 2022, down 64%. And for years, crypto proponents said that owning Bitcoin was a way to subvert the banking system, hedge against inflation, hedge against money printing, the Federal Reserve, big government spending, and other macro shocks. Well, 2022 took a sledgehammer to that narrative as Bitcoin crashed in the face of higher rates and rising inflation. It's obvious now that crypto is simply a risk asset with the longest duration, but I'm surprised at just how poorly it failed in its first test as a macro hedge. Thought that was really interesting, concerning actually. A similar thing happened to all the big tech companies last year. So for the better part of the 2010s, it felt as if technology stocks were untouchable. They're growing like crazy. Everyone's using their products on a daily basis. The performance for many of these companies was off the charts. Companies like Amazon, Facebook, Microsoft, Tesla, all the ones we just mentioned just did phenomenally well. And then COVID hit and it felt like the rich got richer. The pandemic sped up technological adoption, and it seemed like there was no way these companies could ever lose again. They'd only become bigger and more powerful. And yet the majority of the behemoth tech names, except for Apple, got absolutely crushed last year, just destroyed. And so had you loaded up on those things in 2022 or 2021, when everybody wanted to, you would have been hit really, really hard last year. And if you were investing in individual stocks, the odds of losing money were much, much higher than if you diversified into ETFs and mutual funds. You had a 40% chance of losing money if you were investing in individual stocks. You had just a 0.7% chance of losing money if you diversified into ETFs and mutual funds. So I ask you, what odds would you rather have? Diversification is not dead, I assure you. This can even be evidenced when we expand outside of the United States and we look at country returns across all around the world. So what you're looking at is a global return here, somewhere in the middle. It's not the worst for sure, and it's certainly not the best. I mean, who would have guessed that the Turkish stock market would have 100% returns last year? So being globally diversified keeps you always somewhere in the middle, not at the top, not at the bottom, and that's exactly what we try to accomplish with diversification. So we acknowledge that 2022 was not a good year for a diversified portfolio, no doubt about it. It ended up somewhere right here between 2008 and 1930. It was not as bad as 2008 for sure, but it still was painful, down about 13.5%. So you could see some of the other times that we've had really bad results in a 60-40 portfolio. You've got the Depression, the 1937 crash, the 73-74 bear market. Then of course there was 2008. The dot-com bubble that burst. Certainly we've had quite a few times like this, and last year stacked up to be kind of somewhere in the middle in terms of the worst ones. But what happens when we expand our time horizon beyond 1 year and we start looking out to 5 years? You can see that many of the awful 1-year periods actually turned it around. In fact, quite a few of them down here are now positive. So they went through one really bad year, but 5 years later, they're positive. They're all in the positive. And there's just 4 times where a 60-40 portfolio was not positive over a 5-year period. And all of these occasions occurred right around the Great Depression. The good news here is that there's never been a negative return over a 10-year period for a 60-40 diversified portfolio. Could there be a negative return in the future? Sure. There's no such thing as always or negative in the financial markets, but still, this is a pretty decent track record. All right, just for grins, how about let's do one more. Let's look at the 20-year. So as with most case, when you look at the worst case historical performance numbers, most of them started right around 1929, the Great Depression. But it's also interesting to note that 2018 and 2019 were also not fantastic 20-year periods. So the height of the dot-com bubble there, late 90s, 98, 99, was not a terrific entry point into the stock market either. And it's worth pointing out that over all of these worst case scenario 20-year returns, average returns in your worst case 20 years, somewhere between 3.5% to 6% per year, depending on the starting point. And while these returns are not earth-shattering numbers, it's still pretty good as far as a worst case scenario, right? And so I wonder how many of you out there would sign up for a guaranteed 6% return in the next 2 decades right now? Now, past performance is not indicative of future results. We cannot use the word guarantee, all that stuff. You know that. However, it's helpful to zoom out a little bit in our perspective and realize that even in the worst case scenario, 3.5% to 6% returns over a 20-year period, making almost all of your financial plans come to life. So kind of good to take a look at that with a broader perspective. So let's turn the page to 2023. The big question that people are asking is, could we have a second year? Could those losses of 2022 extend into 2023? Now, they could, but history does not support this at all. In fact, there were 4 down years in a row, and they occurred right around the Depression there, 1929 to 1932. The market was also down 3 years in a row from 39 through 41, right around World War II. And then it didn't happen again until we had back-to-back down years there in 73, 74. Those were 2 nasty years. My uncle was an old school stockbroker, and he always would tell me that 73, 74 was way worse than 2008. But the last time that the stock market posted a string of bad returns was the 2000 to 2002 time period, when it fell 3 years in a row during the tech wreck. Right there, the dot-com bubble burst and we had the tech wreck. So you could see that most years are positive, and the odds of having a negative year in 2023 are pretty low. So if it's rare for stocks to have multiple down years in a row, it's even more rare for bonds. The 2-year decline in the bond market that ended in 2022 hadn't happened before since the 1950s. The good news is that there's a lot of green on this chart here. Most years, the bond market is up. So the odds of it being down again are pretty low.
Okay, so here's the best part for everybody. We have some predictions for 2023. And I bet, so go get a pen, your paper, so you can take notes on this, because we've never done it before. You're probably wondering, well, Brad and Matt always say that they lost their crystal ball years ago. So what are the predictions? So however, this year, we're going to take a stab at making some predictions for the very first time.
All right, we are really going out on a limb here. So the number 10 prediction is a lot of people are going to be unhappy with the economy regardless of what happens. So when inflation is low, people are complaining, savers are angry. I can't get any money on my cash at the bank. Inflation's way too low. This is terrible. Savers are getting penalized. And then all of a sudden, inflation's high, and people are saying, oh, they're crushing me, and inflation's crushing me. And so there's always somebody who's going to be unhappy. Number 9, if you own more than one asset class or security in your investment strategy, you're going to be unhappy with something in the portfolio. So something is not going to work in 2023. And the old saying is that when you're properly diversified, there's always going to be a reason to say, sorry, something's not working. But that's how diversification works. That's how you want it to work. You don't want everything to move in the same direction. So if you're properly diversified, you shouldn't expect anything in your portfolio to fire on all cylinders. Number 8, your favorite influencer probably won't make you rich overnight. Number 7, Elon Musk is probably not going to buy another company. That didn't go so well for him. Oh, number 6, the Chargers are not going to win the Super Bowl. They crushed me, up 27-0 at halftime. I mean, I've been rooting for the Chargers even after they left. They were traders. They went to Los Angeles. I'm still rooting for them. Up 27-0. So they're not going to win the Super Bowl again. I'll go on a limb and make that prediction. Tom Cruise is probably not going to win an Oscar, but he should. Did you know that Tom Cruise has never won an Oscar before? He's been nominated several times in the past, Born on the 4th of July, Jerry Maguire, Magnolia, but he's never taken home the hardware. Can we just give him the Best Actor Ever award for his performance in Maverick? I love that movie. Top Gun 2 was a fantastic movie last year. So I don't know. He's good. Oh, this is a huge one. I am definitely not going skydiving with Matt Callahan. That scares me. There's no way. Number 3, the third prediction, you are probably not going to pick the best performing stock of the year in 2023. And so last year, 2022, best performing stock was a company called Target Hospitality, up nearly 320%. Have you ever heard of that? No, I didn't think so, because I haven't either. Target Hospitality, who knew about it? The next best return is from a company called Scorpio Tankers, up also about 300%. The only other stock up 300% last year was a company called Ardmore Shipping Company. So obviously someone owned these names and made some money on it, but it was probably a drop in the ocean in terms of all the overall investors. And the good news is that you do not have to be a fantastic single stock picker to do really, really well in the markets. So our prediction number 2 is that the average investor tends to buy high and sell low, driven by the emotions of fear and greed. And we're not sure which emotions you will feel this coming year, but you're definitely going to feel some emotions. So we predict that people will get emotional about something in the stock market this year for sure. And number 1, the stock market probably will not give us average returns. And as Matt pointed out earlier, yes, the long-term return of the US market is 10%, but it's either up huge or down huge, and it's rarely anywhere in between. So it's probably not going to return anywhere close to 10% next year, which is the long-term average. So in conclusion, we'll start to wrap and then start to share with you some things that we do see happening in 2023 and some bright spots and some things that you should be considering. And maybe the media is not talking about a lot of this stuff, but it's definitely noteworthy.
Mm-hmm. Yeah, so the odds of next year being a negative return year are really low. It's actually a 9% chance that we'll see another negative year in a row. Not saying that it can't happen, but just playing the odds there. And then if you look here at this chart, after we've experienced losses in the past, forward-looking returns tend to be really good. The average 1-year increase for stocks is 13%. And then for bonds, really good after a bad year, 15.5% for bonds following awful years. And so bonds rarely have long stretches of losses, so the current period won't last forever. And what I mean by that is if you look at this chart here on the left, in a 1-month period, 70% of the time, bonds are up. In a 6-month period, 83% of the time, bonds are up. And then 1 year, 90% chance that the bonds are up. And then 3 years, 99% chance. And then 4 and 5 years, there's never been a time that bonds have not been positive over a 4 or 5 year period. So again, this just goes along with our long-term time horizon and long-term thinking that over time, it's very predictable and the portfolios can work well for you over those time frames.
Yeah. So then the other one that you should be aware of, because there's a lot of energy and talk about the Federal Reserve raising rates, and that was a big part of what led to the volatility last year. But when you look back over time, and there's been quite a few of these time periods, the 2000, the mid 90s, 94, 95, when the Fed has raised rates by 0.5% or more per year, the stock market actually performs quite well, up nearly 9% 6 months later, and the bond market too, up nearly 6%. So the old analogy that, well, when the Fed raises rates, stocks can't go up, just the data would just show you that it's not true. So that's good to know. I think what really caught people off guard last year was the speed at which the rates went up. It was really quick. As Matt pointed out earlier, mortgage interest rates about doubled in a short time period. Here's the good news. This is the good news. Now, I know it's not any of you out there, but satisfaction level is very often a contrarian indicator. And what that means is when people are the least happy, when they're not happy about what's going on out there. So as evidence right now, we're at some pretty low points in terms of consumer sentiment. I mean, we're not quite as negative as we were in December of 2008, but we're getting down there. Not quite as negative of the recession years of 92, but we're getting down there, kind of like the late 70s. So we're sort of in that ballpark of some pretty dark periods when the country felt really down and out about things. Well, here's the great news. When people are feeling the worst, the stock market tends to return the best. In other words, when less than 34% of the country is satisfied, the average stock market return a year later is up 15.2%. And take a look at where we're at today. Just 21% of the country is satisfied right now. So that's a very good omen for stocks and the stock market in general. And couple that with, I want to add a little word on dividends. So back in 1950, dividends per share were $1.15. Today, dividends are more than $60 a share. That's compound annual growth of almost 6% per year. Earnings growth was really similar over that time period, growing from $2.34 a share in the 50s up to $190 per share today. Again, that's about 6% per year compound growth. In that same time period, the average inflation rate was right around 3%. So the growth rate of dividends was about double that of the inflation rate. In other words, by owning shares of the best companies in the world like you do, the dividends alone were helping you to handily outpace inflation, which is great to know. So the market has been resilient in the past, and we believe it's going to continue to be. After large down years like last year, the market tends to be up significantly 1 year later. So let's take a look at some of them. Black Monday was actually my birthday back in 1987. Market dropped 20% in a day and about 33.5% in that same time period. 1 year later, it's up 21.4%. The Gulf War, market's down about 20. 1 year later, it's up about 30. We had the Asia monetary crisis of the late 90s, down about 20. A year later, up almost 38%. We had the tech bubble, 2000 to 02. Market lost about half of its value in that 3-year time period. We had 9/11 right in the middle of that. And a year after it ended, market is up nearly 34%. And then, of course, the financial crisis of 08, the market was cut more than in half in that time period. But a year later, it was up nearly 70%. Then, of course, let's talk about COVID. Market's down almost 34% in about a month. And a year later, it's up almost 78%. So historically speaking, the market has been very, very resilient, and we believe it's going to be that way again. So it's easy to get caught up in all the negative returns of last year. And even on a trailing 12-month basis, we have some negative returns. But when we expand our horizon out to 10 years, that's where you can see that everything across the board, and even bonds, everything is positive over a 10-year period. And it just goes to show you that the more patience you have, the more you maintain your discipline, the more that you don't give in to those emotions and let the markets work for you, things turn out to be really, really solid.
Yeah, and then Brad, one more point on that, if we can go back. I know we've said it to most people on the call, but for the newer people on the call, that maybe you're just transitioning into retirement and you think that's the finish line, you have to remember that we're planning for, a 20, 30, even a 40-year retirement. So you do have the time horizon to be able to weather through those short-term storms.
Right. It's so true, Matt. I mean, how many times do you hear people say, oh, but I don't have this kind of time horizon. I don't have 10 years to, and I think they're anchoring in on maybe they're not working in that 10-year, 20-year time period, but they're going to live. 10,
Mhm.
20, 30 years plus. And I think that's one of the common mistakes that we see people make is they really lock in, they think they're time hurrying. And nobody believes that they're going to be the one that lives to their mid 90s. But statistically speaking, there's about a 50% probability of making it to your early to mid 90s. So investing for growth is really important.
Mhm.
Whoops. So I got to share with you, here we go. This is backed by popular demand. It's the world famous Skittles chart. You guys have all been asking about the Skittles chart. And so we brought it back for you. And there's a couple of really interesting stories to point out here. And we're looking at the last 10 years, 2013 to 2022. I want to talk about the 10 years that preceded this year, really almost the 15 years. So take a look at this. From 2013 to 2022, the top performing asset class was US large companies. So S&P 500 type companies, right? And it is so interesting to me because the 15-year period right before that, the US companies absolutely tanked. In fact, they had a lost decade from 2000 to 2009, where big US companies lost 1% per year for an entire decade. And you contrast that to this yellow box here, the emerging markets, which in the last 10 years actually didn't do that well, 2.25% roughly, pretty paltry returns. Had a lot to do with the strengthening of the US dollar. And for folks who like to travel, we've been saying for a while now, travel while you can, because US dollar is still really strong. It's been strong for a while. It's not going to remain. It just things cycle. And so the cycle has been the US dollar's been really strong for a while, which has resulted in less than favorable returns on the international markets, as evidenced right here by emerging markets at 2.25. Well, I want to take you back to the decade before, and it was just reversed. The emerging markets was in first place. It quadrupled in a roughly 14-year period from 2000 to 2013. And then after quadrupling, it just cooled off. Well, in that 2000 to 2013 period, the US market compounded at less than half of its long-term average in the low fours. And then it turned on in this most recent decade. So you can see these large swings, high highs and low lows. And I think the stressful thing is, if you're trying to do this on your own and you're trying to do individual stocks, trying to figure out what to own, when to own it, how much of it to own, when to rebalance. I mean, you can see here that these swings are wild. But take a look at this. It's pretty cool. I want you to look at the white box here. And this is the 60-40 portfolio that we've been talking about. Now, not everybody out there has a 60-40 portfolio. Everybody has their own customized mix of asset classes. Some people are more aggressive than this. Some people are more conservative than this. So it's very unique to you and your financial plan. But I think this is a good proxy for kind of a modest amount of risk in a diversified mix, basically a diversified portfolio that we've been talking about. And had you owned a diversified portfolio for a decade, your long-term returns over a pretty volatile decade here with COVID and 2022 and the elections of 2016 and 2020 and the really flat years in the markets there of 2014 and 15. So in a pretty tumultuous decade, this diversified portfolio compounded at over 6% per year, making people almost double their money in this 10-year time period. And what I want to call your attention to is follow along all the way back to 2013 and notice that the white box, the 60-40 portfolio, it's never at the top. It's also never at the bottom. And it tends to stay, kind of plunks along here right in the middle, never at the top, never at the bottom. And it just kind of stays right in the middle. And that's by design. We want to try to smooth out the peaks and the valleys in your ride. We want to still give you the long-term growth that you're going to need to make your plan come to life. But we want to do it in such a way that you can sleep at night. You can not have to lay awake, frightened about whatever may be going on. We're rebalancing all the way through. And so what that means is any asset class that's at the top, it's usually the top 2 or 3 performers in any given year. We're studying those. And we're looking at the 2 or 3 asset classes that are at the bottom of the heap in any given year. And we're trimming, we're selling the things that were up, and we're buying into the things that were down. And what I find so interesting is we all know that we should do that. Yeah, Warren Buffett says buy low and sell high. And yet when I tell you that you need to sell the very thing that was your best performer last year, most people kind of tense up a little bit. Though I don't want to let go of that. It's my, it's my favorite. It's my favorite position.
Brad, I said earlier today, actually, remember that the stock market is the only thing where there can be a 20% discount and people don't want to go buy. But if it's your favorite store and I tell you it's 20%, you're going to go out there doing whatever you can to go try to buy more of your favorite thing.
Yeah. Hey, Nordstrom's is having a 30% off sale tomorrow. Are you a seller or a buyer? Yeah, you're so right, Matt. It's people just get really nervous, but that's okay. We have a disciplined, systematic approach to the investment process, and you can see here that it's paying off. And so, if you just give it the time that it deserves, most everybody is going to be in fantastic shape over time. And so, cheers to a successful 2023. And it's a pleasure to work with all of you. It's really a joy to be on this journey with you, Matt and I, and the whole team. We take that very seriously. It's really an honor and a privilege. And we have such great relationships with all of you. And we believe that it's important for you to be empowered around your finances and your money, and that's why we do events like this. So with that, we're going to open it up for questions, and we'll see what's out there. So if you have any questions, oh, here we go. Somebody's saying no ties.
Oh,
thank you.
Yeah, I appreciate that too.
Yeah. Okay. Here's a question. It's come. All right. So with all the talk about how bad the bond market was, the question is, should we be owning bonds anymore, or should we get rid of our bonds? That's a great question. So I'll take you back to this time last year. So when interest rates rose as fast as they did, that's exactly what led to such an awful year in the bond market. What's interesting though is finally these bonds that you've owned for 15 years, which have paid nothing. I mean, coming out of the 2008 financial crisis, bonds have paid nothing for almost 15 years. Bonds are finally paying something now, and we're seeing 4 to 6% yield on the bonds. So, and then you saw the slide that Matt showed earlier that after bonds get hit hard, they tend to respond really, really well, up 15% on the following 12 months. And so this is not the time to ditch your bonds. I think just maintaining discipline is really, really the key here. But we are so much more optimistic about bonds today than we were last year. And we've been telling people for years, we anticipated that at some point there was going to be a rotation. At some point, this was going to happen to the bond market. Problem is, you never know when. You just don't know when that's going to happen. You cannot time it. And when it happens really quick. So some protective measures that we were taking leading up to last year, we've been doing this for years. We shortened the duration, meaning the length of the bonds, we shortened it down. So that's a safer area of the bond market. And we increased the credit quality of the bonds. And as evidenced, when you look at the performance of the bonds in your portfolio, the Barclays aggregate bond index was down over 13%. I mean, worst year ever. Most bonds in your portfolio were down single digits. That's still painful. It's not a fun thing to take, but it's nice to know that there was some protection there by going short-term high quality. So the takeaway is now is not the time to ditch bonds. And you'd have to ask yourself, if you did, what would you do? Would you put it all in stocks or equities? Now, over the long run, that would definitely compound and create more wealth for you, but it would sure increase the volatility of the portfolio. So if you were in distribution years needing to take income out of that portfolio and replace your paycheck, having more volatility doesn't actually help you. So I think the long and short of it is don't ditch the bonds. Rebalance through whatever the markets are giving you. Good
And
question.
Brett, I have one here.
Okay.
It says, if I'm planning to retire, should I postpone at least a year? That's a great question. A couple of things here. If you plan to work one more year before retiring, it's actually buying you 2 years in retirement. And so something to consider, what I mean by that is that you get one more year of making income, so you're not taking distributions out of your investment portfolio, and it gives you another year to save in your retirement accounts. I think a bigger issue that you want to keep in mind when thinking about transitioning into retirement is sequence of returns risk. And that is if you are transitioning into retirement and you're having to take distributions out of your portfolio. It really does make a huge difference if you're having negative returns in early years in retirement versus getting positive returns. So you just want to look and to make sure it, depending on how much you have to take out of your investment portfolios to fund retirement. But these are things that you'll want to make sure just to dive into in your individual plan to see what makes most sense.
Good point. And so someone's asking to revisit the comments about the dividend growth. So yes, it's so interesting on dividends. So when companies earn income and they have profit, the growth companies will usually keep that revenue and keep that profit, and they'll invest in research and development. And so Apple is trying to make the next bet, the Apple iPhone 22 or whatever, they're up in the game for technology. Other companies, I'll give you an example, Coca-Cola is not doing a lot of research and development to come up with a new formula of Coca-Cola. So they have excess revenue and they're paying it back to the shareholder in the form of dividends. And so the point I was making earlier is that over the last 60 years, the dividend growth rate, so companies deciding, oh, we're gonna return more to our shareholders for being good shareholders and to thank them. That growth rate, the dividend growth rate alone, has been 6% per year for 60 years. And so another way of saying it is, if the stock market has returned 10% per year, 6% of the 10, 6 of the 10 is due to the dividend, what the dividend's paying. The other 4% is capital appreciation. So the dividend growth rate has grown at 6% per year. Meanwhile, inflation has been growing at around 3% per year. So the rate of dividend growth is doubling the rate of inflation just for owning the great companies that you own. And there's a lot of comfort there. Just on their own, the companies are helping you to achieve your goals just through dividends. It's fantastic. Okay, Matt, so then the question always comes up, so I'll ask it. Oh, I heard Matt and Brad talk about dividends. What about an income portfolio full of nothing but dividend stocks? Let's just really I want a 9% dividend. We've seen portfolios where people bring that stuff in here. We hear the questions. What are your thoughts on that? What's the potential downside, if any?
Yeah, I think it's similar to the concept of not putting your eggs in one basket. So what we really want to look for is total return. We want some of the growth coming from dividends and cap gains, and then some of it coming from a capital appreciation of the underlying holdings. And so there's just a fine balance there. You don't want to just target one or the other, because keep in mind too, a high yielding fund or ETF, the volatility substantially increases, and you have to be aware that within your portfolio, you're adding potentially unnecessary risk.
Yeah, exactly. On a practical level, if all you did was just concentrate on dividends, you'd miss some really key asset classes like US small cap, international small cap, emerging markets. And so your portfolio would not be well diversified. And so over the long run, that's not the ideal solution. Although we love dividends, it just shouldn't be the only focus.
Mm-hmm. And I guess that kind of ties in one question, Brad, here is if we're selling high and buying low, like on the Skittles chart for asset reallocation, are some of the buys buying a 40% plus? Is that?
Oh, okay. So no, okay, I see what you're thinking. When an asset class goes up 40%, so there's years here I'll pick on. So REITs in 2021 up 46%, REITs in 2014 up 32%, US small cap 2013 up 38%. So that's the asset. Those are the asset classes that literally ran away with the pack that year. Okay. And so we're not saying that you would sell the entire asset class. We're just saying that on the whole, because of its strong performance, you now have a little bit too much of it. You own too much of it and you're a little top heavy, if you will. You're a little concentrated in that winner or the winners. And you're a little underrepresented in your losers and the things that didn't do well that year. So we're not saying sell the entire asset class. And in all practicality, we will let these asset classes drift anywhere between 2 and 4% from its original target value. And the reason why is when things are running, when things have momentum, you want to let them run. But then all of a sudden there's a line in the sand where it's like, okay, and we've studied it. Every asset class is different. The more volatile asset classes will give them a kind of like a thoroughbred horse. You just got to let it run a little bit. And then there's other asset classes that are more like the plow horse, where this thing's not going to run fast. So if there's too big of a move, something really bad has happened. So we've got these thresholds around every one of the asset classes that you see on the chart. And when they represent anywhere from 2 to 4% too much or too little in the portfolio, that's what's going to trigger the sell if it's up and it represents too much, and then the subsequent buy of whatever's down and you don't have enough. So we're not selling the entire asset class. And it's trimming. Look at it like mowing the lawn, trimming the hedges, just making it nice and tight and tidy looking. That's what rebalancing does. And this adds to your bottom line over time. This helps to mitigate risk, and this helps to increase your performance over time. Hey, Matt, we're getting questions around Secure Act. I'm glad. Thanks for asking those questions. We didn't touch on Secure Act, and let's do that. What are some of your highlights? What do you think that the audience needs to know about Secure Act 2.0? And then I can share my thoughts too.
Okay. I think the biggest thing for most of the people on this call is that the required minimum distribution rule, or it used to be 72, is being pushed out to age 73, and then later down the road to age 75. I see this as positive for most of you on the call as well, because this allows you to delay those distributions longer. What we're seeing in a lot of financial plans is that people aren't needing the assets from their required minimum distribution. So it allows us to delay paying taxes or use other strategies to reduce taxes in the future later. Go ahead.
Oh, absolutely. Yeah, I was just going to say, anyone born after 1960, your new required minimum, your RMD age is going to be 75. And I just echo what you say, Matt. This is we call this the gap years, the years between retirement and RMDs. Those are beautiful years to do Roth conversions and really start to shift that tax burden while you're in a lower income bracket. What else, Matt? What else about Secure Act 2.0? What about the 529? This is really interesting planning strategies on 529s.
Yeah, great. So we get a lot of questions with people wanting to put money into 529 plans, which are college saving vehicles or higher education saving vehicles. And we get some, not pushback, but just some concerns of overfunding these types of accounts, because if you don't use it, or if you used it in the past, not for higher education, there could be penalties involved to get the dollars out. The rule, a little more complicated than this, but if you've had the account for 15 years, that you can now do a rollover into a Roth IRA for the beneficiary. You can't do a full rollover like you would be able to do with a 401k going into an IRA, but you can do little chunks at a time in the amount of the contribution limits for the year.
Right. So here's how the strategy would play out. Your child graduates college. You've got extra money in the 529. And they get their first job. So they still have to meet all the requirements. They have to have earned income. The most they could put in for this year would be $6,500. But you can essentially say, okay, we'll take $6,500 from the 529 and roll that into their Roth IRA. So it's helping them to make the Roth contribution. And then the smart thing would be, okay, son or daughter, instead of you making a contribution to your Roth, take that $6,500 and put it into your house down payment fund. So have them redirect what they would have saved towards the down payment fund. Because we see those are some, a lot of folks here, you've got kids, you got adult kids, you want them to be able to, your biggest concern for them is launching them into the world and then making sure that they can buy a house. here, which is challenging. So I think the trickle down effect here is that a lot of boxes can get checked because of that new 529 rule. And the maximum you can do in a lifetime is $35,000.
Yeah, and then one more that stood out to me that I like is that if you're a small business owner or work for a small business, different plans like a simplified employee pension or a simple IRA are now going to allow you in the future to make direct Roth contributions. That wasn't available until recently. And then another cool thing with 401ks going forward is that the match from the business, if you're lucky enough to have that with your plan, can now be going into your Roth component. Originally, the match was only allowed to go into your pre-tax bucket. And just keep in mind, I mean, that will be added to your income. So you just want to be aware of the tax consequences that could arise by changing it to the Roth contribution rather than the pre-tax.
Yep. And then a couple of other key things to note. If you're over the age of 50 and you're working, you could put $30,000 a year into your 401k plan. If you're 61, 62, or 63, instead of the contribution, the catch up being 7,500, you can get an extra 10 grand in your 401k. So I think that brings the number to 32,500 just for age 61, 62, and 63. They're really encouraging people to save money. So do take advantage of the increased contribution amounts this year.
And then we did get a couple of questions on annuity or insurance products and what our thoughts. I would say in general, we like the products. They do have a place in certain financial plans. With regard to growing your wealth, I think that's a poor place to warehouse your cash and grow wealth there just because of high fees and different things like that. But if you're using a product to create a flooring strategy, which is taking a piece off out of the investment world and putting it into an annuity to create a stream of income that you can outlive, it can make a lot of sense to maybe bridge the gap years to allow you to delay Social Security and different strategies like that. But in general, I'd say, yes, they have their place, not against them. It just has to make sense for your financial plan, and just ask a lot of questions when you're looking to get into those products, because sometimes if you purchase an insurance product, you kind of, once you buy it, you lose it. So you can't unwind the decision after you make it.
Yeah, and I think just the thing that we always coach people, and just if you're gonna purchase an annuity, be really careful, because the fees can be very expensive. They can be quite high. There could be there's a lot of rules around what you may be purchasing. So just understand what you're buying and go into it eyes wide open. Where we've seen annuities be pretty successful, rather than a variable annuity, which is really expensive and it pays somebody a really healthy commission. So just, you got to always be careful what's incentivizing the person who's selling it to you. So just watch out. Where we've seen annuities work well is to help fund the gap years, as you're talking. So the single premium immediate annuities, where you give a chunk of change to an insurance company and then they turn that into an income stream, and it buys you some time to delay taking your Social Security. And every year that you're delaying Social Security, it's going up at 8% per year. Well, for the last 15 years, in looking at these strategies, the SPIAs, those single premium immediate annuities, interest rates were so low that basically the insurance company's just essentially returning your principal to you with very little interest. Well, it's getting interesting now that interest rates have gone up. We're seeing there are positive impacts of the higher rates that no one's talking about, but cash savings is yielding a lot more than it did 2 years ago. These SPIA annuities are now going to be paying a lot more. So it will be interesting to revisit that as a tool in a well-designed retirement income plan. Matt, here's one about debt ceiling. How's that going to affect retirees?
I don't know if I have a good answer for that, but let me say this, and then you can add to it. My thought behind the debt ceiling and the scare is that we've been here before, and it's a terrible answer, but they continue to raise that debt ceiling, and it hasn't caused an issue yet. But I'd love to hear your thoughts.
Yeah, really similar. I mean, the concern, of course, is that as the deadline looms, the stock market starts to digest and then price it in, and then all of a sudden it gets volatile. If Congress isn't taking action, it seems like it's a game of chicken, and there's a lot of political posturing, and there's a lot of things that go back and forth. The good news, though, is that we are not investing in politicians. We are not investing in governments. We're investing in companies, some of the best, most well-run companies around the world. And these companies are staying awake at night figuring out, okay, if we have a debt ceiling crisis, how's that going to affect our business? How's that going to affect our revenue and our profits? And what do we need to do to maintain the profit margin that we need to? So that gives me hope, knowing that you own great companies and they make it their business 24/7 to navigate whatever the world and the markets and our politicians may be throwing at them. So thank goodness we're not investing in politicians.
And then one more, is it good to roll a 401k over into an IRA upon retirement for more investment options? I would say yes. You can typically get, well, you get the full scope of investment options, so you can usually find cheaper investments to use. And then also maybe some people think that they're confused that they are diversified because they have a 401k over at their employer. They have their IRA at their investment firm, and they've got another 401k that they left at an old employer, and they think that they're diversified because of these 3 accounts. But really, you should bring all of them into one portfolio for a couple of reasons. You can avoid redundancies or overlap. If you're managing 3 different portfolios, it's almost like going and say you need knee surgery and you go to a doctor and have them do half of the surgery and stop midway through, and then go to a new doctor and say, hey, can you fix up the stuff that the other guy did? So you really want to just have one portfolio all working concurrently to accomplish your goals and objectives with your plan.
Yeah, no doubt. Here's a good question about REITs, just kind of our thoughts about REITs. And I think I'll expand that beyond just REITs and maybe just make it more broad brushed about just the real estate market in general. No doubt about it. When you look at 2020 and 2021, the real estate market had a boom. And it was at the end of this really long period, about 15 years of low interest rates, and they went lower during the pandemic and to help prop the economy up. And then all of a sudden, the real estate market just went bananas. So the Fed finally realized, okay, we've got to raise rates to slow this thing down. Mortgage interest rates doubled up to 7. And so we saw, and we continue to see, a cooling off in the real estate market. And so the question is, I'll just share with you what I'm hearing from the real estate professionals that we talk to on a consistent basis. I'm hearing that there are some pockets of the country that have been hit much harder than others. I'm hearing that San Diego, of all the markets, was one of the few that's going to have a very soft landing because it's still very desirable. You have some of the tech companies like Apple and Google are creating jobs here. It's still much less expensive than the Bay Area. So I think the San Diego real estate market is going to be okay. I think there's other pockets of the country that are going to get hit pretty hard. And then on the commercial and industrial side, I think you have to be really selective. The brokers and agents who I talk to say that office space is a really risky play right now. So if you've got a lot of courage and a lot of guts, and you're contrarian minded, commercial office space would be a pretty risky, pretty bold purchase these days. But I'm hearing smart money is continuing to talk about multifamily and storage, which they've been talking. That's an old story, but it seems to be just this consistent income generating investment vehicle. At some point, I think the higher rates are going to continue taking a toll on real estate. But like all the cycles that we've seen here, they're going to have their day in the sun again. I mean, they've had a long period. Real estate is going to be a wonderful long-term investment. I don't think real estate's going away. I think that valuations are kind of sorting themselves out in light of, I think the speed at the interest rate increase caught people off guard. So I wouldn't throw the baby out with the bathwater there on real estate, but it could be another dicey, choppy year for the real estate market until we have more clarity on the direction of interest rates. Okay, well, there's a lot more questions. We're just running out of time here. So if we didn't get a chance to answer your question, we can schedule some time, or we can address it offline here. Just want to say thanks again It's just a pleasure to work with you. It really is a joy. And we love doing events like this. So be on the lookout. We're going to be doing our wind down the tax season on April 18th. Bring in your tax return and share a glass of wine with us. We think forward-looking tax planning is so important and very critical of our job as your financial advisors. So we want your tax returns, and we're enticing you with wine. We're looking at other educational events later in the year. In fact, so we're talking about Social Security, Medicare, and health and wellness. And we'd be curious to know your thoughts. Is there a subject that you would enjoy us bringing to your attention? We got some energy around annuities here on this call. I mean, we can do an event on annuities or an educational thing on annuities. So feel free to email Matt or I, and just let us know your thoughts. If there's something that we can bring to bear, we're happy to do it. So again, it's a pleasure. On behalf of Matt, I just want to say thank you very much. And we really enjoy working with you.
All right.
So take
You all
care.
have a good
everybody.
evening, and we'll talk to you soon.